You know, guys, there's a very interesting similarity in which how Bank Nifty behaved yesterday and how Bajaj Finance also behaved
Yeah.
right before that. Which one gets a, looking at the screen, one gets a sense that probably market had a wind of it. Because if you analyze Bajaj Finance fall in the last hour, day before, everything, all the other financial NBFCs were fine. Bajaj Finance suddenly fell off and then ended at day's low. The next day, you saw the bad news come in and the stock bottomed in the first hour of trade. Will Bank Nifty also see the same fate is something to watch out for, because this increase of weights doesn't really come as a surprise. RBI on various platforms and their monthly bulletin was already giving a hint that they are not comfortable at the speed at which consumer loans are actually growing. And so one saw it come. And if you really take a deep look inside what exactly has come, this actually increases the capital raise requirement for the banks, not for NBFCs as such. NBFC will pass it on. They are converters. Their cost of borrowing go up, they pass it on. Yes, at the cost of a bit of growth, right? You saw Bank of Baroda last evening already put out to exchanges that they are meeting for capital raise. So Bank Nifty in isolation fell in last hour of trade today. So it will be very interesting to see whether first hour of trade today Bank Nifty makes the intraday bottom or not. Because otherwise, if you look at the bigger picture, slightly bigger picture, do you think banks will find it difficult to raise capital in current environment? Absolutely not, right? Because the roadmap of growth and all. But near term, yes, there could be some pressure. Also, look at the way how carefully RBI excluded certain sectors from this, MFI, priority sector lending, MSME, education, housing. So, if you look at the overall construct of the NBFC loan book, 80% is actually left behind. So, there is no really big worry, right? So, this is interesting, and crude, of course, is a big bonanza. It has been falling off. So, I think Bank Nifty will get support from the crude fall also. Whenever there is a sharp fall in crude, the yields actually soften and the blow will get cushioned to some extent. But of course, we are putting the spotlight on what's happening on this issue of higher risk weights on consumer loans and personal loans in particular. We have somebody who understands this entire space very closely. Of course, Keki Mistry has been heading the biggest mortgage company in India for a very long time, and he is now joining us to help us understand this initial news which has actually come in. It has made large parts of the market slightly nervous. Keki, thank you very much for your time, and appreciate you joining us right early in the day. What are your initial thoughts on this latest circular from the RBI? And also, if you can help us understand in layman terms the impact it would have on the financial sector, banks, NBFCs, all of them.
See, my view is that RBI for the last nearly 2 months has been continuously making some remark or the other or some comment on the other about the fact that the quantum of unsecured lending in the system has increased a lot, and RBI is a little concerned about it. So one was expecting some kind of regulatory action around that. What exactly that action would be, obviously one did not know. And now we know that what they've done is that the risk weight on these loans has been increased by 25 percentage points. So where it was 100%, it's become 125%. Where it was 125%, it has become 150%. Now, fortunately, to the best of my knowledge, whatever little I've known and spoken to people in the system, people are still not seeing any concern or any deterioration in terms of asset quality as far as the unsecured loans are concerned. So to my mind, this is a precautionary measure by RBI, a welcome precautionary measure, given the fact that the lending to this sector, to this kind of lending has increased so much in the system. So it's more precautionary. All it means is that the banks and the NBFCs will now need to provide more capital when they do these loans. Providing more capital means that the return on equity on those loans comes down to some extent. That's the implication.
Right. Keki, but were you surprised by the move at all, or would you say that the RBI has been extra cautious, has been giving out hints out there? Your initial thoughts on the extent, the coverage, and the quantum of these measures?
See, the Reserve Bank has been talking not just of the higher degree of loans to a higher degree of unsecured lending in the system. They've also expressed some concern about the amount of lending that banks are doing to NBFCs. And most of these NBFCs, or some of these NBFCs, let's not say most, some of these NBFCs are using the capital, the money that they get from banks for giving these kind of unsecured loans. So that is where the link comes between the banks and the lending. Now, I don't know whether this would apply to, for example, a loan given to a LIC housing finance. When a bank lends to LIC housing finance, LIC housing finance in turn does only secured lending. It does not do unsecured lending to the best of my knowledge. And therefore, logically, if we extend the logic of the circular, it would probably not apply to lending to an NBFC which is giving secured loans. But again, I'm sure a clarity on that will emerge in a day or two.
Sure, Mr. Mistry, point taken. But the bulk of the credit growth in the last few quarters was actually coming in from consumer and retail loans. That was the area which was firing up for all of these financials, which is resulting in that 20-30% kind of growth. Do you think the circular will now impair the credit growth rate and it will come off meaningfully?
To some extent, yes, the growth rate would come down because, as I said, at the end of the day, a bank or an NBFC provides loans based on profitability of a product. When you determine the profitability of a product, you look at the risk involved, you look at the provisioning required, you look at asset quality in terms of past track record of non-performing loans, and of course, you look at the amount of capital you need to provide. Now, one of these factors has changed, which is that the capital you require for giving these loans has increased, and therefore, to that extent, the profitability is lower. So therefore, if the NBFC's profitability on a certain product is lower, their growth on that product could also possibly come down, unless you are looking at a bank or NBFC which is extremely well capitalized. These are signals from RBI, so I'm sure that the banks and the NBFCs will pay heed and will slow down to some extent some of this lending.
So, Keki, we were just discussing how the impact on banks would actually be, whether it's their capital raising requirements or not. And will PSUs in particular among the banks be hit more than private banks and NBFCs in your view?
Well, any bank where the capital ratio is lower will to that extent be more impacted than banks who have a higher capital ratio. Also, if you look at the NBFCs, barring a handful of these NBFCs, most NBFCs are today extremely well capitalized. If you look at the balance sheet and the capital ratios of many of the large NBFCs, they are very well capitalized. So to my mind, all it does is it reduces the return on equity that you generate on that loan. It may make these kind of loans a little less attractive compared to what they were in the past. And it would probably slow down lending to this sector, which is what RBI wants.
Right. Keki, so in your assessment and conversation, with your peers, you're not hearing anything about asset quality issues, are you? Because we understand that a couple of NBFCs like Chola did raise some concern within the unsecured lending to an extent.
Well, to the best of my knowledge, based on the people that I have spoken to, I have not been given to feel by anyone that they are seeing any significant deterioration in asset quality. But these things come with a lag. Our economy is growing so well and so strongly at the moment that the risk at this point of time could become lesser. That is probably RBI's point, that today the risk may be lesser. Tomorrow the risk could increase if for whatever reason there is a global issue, there is some geopolitical issue and the growth slows down a little bit, which I don't think will happen. But that could be, obviously, as a central bank, you have to look for those kind of events.
Sure. And Keki, what would be the impact for credit card players like SBI cards? Because of course, for them, there should be a bigger hit, right? And even the platforms like Paytm, in your assessment, because they were getting into unsecured lending.
Look, I don't know specifically about any particular company, and I don't want to comment on any particular company, but the risk weights on all these products has increased. So I don't think there is any specific concern with regard only to credit cards. It's a general concern with regard to unsecured lending. It could possibly just mean that some of these credit card companies could increase the interest rate that they charge. Could happen, I don't know, to compensate for the slower growth, a slightly marginal a loss, or not loss, but a marginal reduction in their profitability on these products. That is again left to each company.
So much for joining us this morning and helping us understand this very important developing story today. Keki, of course, is traveling right now and he joined us from Dubai. But thanks very much, Keki, for your time.